All right, tonight we continue from where we stopped. We are looking at financial statement analysis. Like we said in our last class last week, financial statement analysis is a skill that every accountant must have, regardless of your field of accounting, whether you choose to be a tax accountant, an audit and assurance provider, or you choose to be a corporate reporting expert, you must understand how to carry out financial statement analysis. What is financial statement analysis? We explained this last week as the analysis of a firm's financial statement. The analysis of the financial statements of a business entity with a view to determining the company's past financial performance and to project the company's future financial prospects. This analysis involves...
We can't hear you clear, sir. Your volume is so faint.
Oh, the volume is low.
Yes, sir.
The volume is fine. It's fine now.
Okay, I'm surprised. Mr. Hussein.
Yes, sir.
The volume of my system is on 100%. I'm at the top of my voice. If you cannot hear me very well, there are two possibilities. It's either your device, your network is failing, or it's coming from my hand. If most students cannot hear me loudly, that means the problem is for my device. But if a particular student is having a problem of volume, that means the problem is from the student, that particular student device.
Yes, sir. Sorry, I've relogged in.
Okay, you can hear me clearly now.
Yes, sir. I've relogged in. It's clear, sir. Thank you.
All right, sir. So, we said financial statement analysis is the evaluation of a company's financial statements, and the objective is to evaluate or to assess the company's past financial performance and to project the company's future financial prospects. This analysis involves the analysis of the company's income statements, the statement of financial position, and the analysis of the company's cash flow statement. To carry out this analysis, we have different tools or different instruments that can be used. You can use horizontal analysis, otherwise known as trend analysis. Under horizontal analysis, we compare the financial result of 1 year with the financial result of another year. For example, you can compare the financial result of 2023 with the financial result of 2024, with the financial result of 2025, if you are doing that, you are doing trend analysis. Number two, we have vertical analysis of the financial statements. Under vertical analysis, you compare items in the income statements with a major item in the income statement. For example, you can look at the ratio of profit to sales, the ratio of fixed cost to sales, the ratio of interest cost to sales. You are going to compare items in the income statement with a major item that happens in the income statement. This is called vertical analysis of the financial statement. Lastly, you can do what we call ratio analysis, financial ratio analysis. We can use financial ratio to evaluate the performance of a company. What are these ratios? Profitability ratios, liquidity ratios, financial risk ratio, and we have investors ratio. This was discussed in our last week class. Thereafter, we look at a question on this topic. The question we addressed last week. That question number one, Choice Aluminum PLC. That question is on financial statements, financial performance evaluation. There are three ways. Please note this point. There are three ways examiner can test question on financial statement analysis. There are three ways or three scenarios that could be created when it comes to financial statement analysis. The first one is you may be required to carry out financial performance evaluation. Like the question we solved last week. We are giving financial statements for 4 years, 2014 to 2017, for a company known as Choice Aluminum. And we are required to evaluate that company's financial performance. That is one scenario. Now, the second scenario is you may be required to carry out financial statement prediction or financial statement forecasting. You are giving the financial statement for a particular year. For example, you may be giving the financial statement for 2025. And you are required to forecast financial statement for 2026. You are giving the financial statement of a company for 2025. The examiner now asks you that forecast financial statement for this company for 2026. That is financial statement forecasting or financial statement prediction. Please note Please note, if you are required to carry out financial statement prediction, that is, you want to project a company financial, you want to project a company future financial statements. At any point in time, the examiner is texting financial statement prediction. What the examiner is trying to text is your knowledge of accounting principles. I'll repeat that point. At any point in time, you are required to carry out financial statement prediction. What the examiner is trying to text is your knowledge of accounting principle. Remember the double entry principle. For every debit entry, there must be a corresponding credit entry. Also remember, under accounting principles, what are the items of the income statement? What are the items of the balance sheet statements? What are the items of the cash flow statement? You must understand the items to be posted to the income statement. What are these items? Your sales revenue, your cost of goods sold, your interest cost, your taxation. These are the items of the income statement. From your income statement, you are going to get the operating profit. You are going to get the profit after tax. You are going to talk of dividend payable or paid. These items are the items of the income statement. Next, what are the items of the statement of financial position? You have your non-current assets. You have your current assets. You have your capital and reserves. You have your current liabilities, non-current liabilities. These are the items of the balance sheet statement. All right. And the third scenario is that where I didn't bother to respond because I know that my network is not breaking. If your network is breaking, it is from your point, not my end. So you may probably log out and log in. My network is perfectly okay here. All right, the third scenario is you may be required to use financial statements to guide strategic decision making. You may be required to use financial statements as a guide to strategic decision making. These are the three scenarios that could be created. All right. Tonight we are looking at question number 2, page 148/149. Please, let's go to our study pack. We are looking at question number 2. This question is on financial statement prediction. Let us go to our study pack, page 148-149, illustration 2. The question is
Food for
on
thought.
food for thought, PSC. The question is food for thought, PSC. In your study pack is going to be question 2, page 148. All right, let's go to this question together. Food for thought, PSC, is a quick service restaurant. The business has traded very successfully for many years. FFT outlets offered food and beverages for takeouts. Why are you touching my screen? Food for thought outlets offer food and beverages for takeouts and delivery only. There was no dial-in option available. The rapid expansion of food delivery service provided a strong headwind for FFT. Since their outlets did not require a prominent location, the leasing costs were minimized. The increase in the number of similar offerings from competitors, however, has resulted in the need to reinvigorate the product range. A plan to launch new food options by the directors is expected to increase revenue by 10% per annum for the foreseeable future. So the company is planning to launch a new food option new food options. And this is expected to increase revenue by 10% per annum for the foreseeable future. In order to finance the expansion, the directors are considering either a rights issue or a new debt finance. So the company is considering expanding its business to introduce a new product, a new food option. To finance this expansion, the director is looking at rights issue or new debt finance. Next, the overhead of the business should not be affected by the expansion in sales. Next, other relevant information is as follows. The level of competitive rivalry between the suppliers to this industry is very pronounced. As a result, please stop touching my screen. This is where we are. The level of competitive rivalry between the suppliers to the industry is very pronounced. And as a result, an increase in direct cost of only 8% per annum is expected. Next, the working capital will be controlled in the same fashion as before, with no changes anticipated to the terms of trade. Thus, the amount of credit taken in proportion to revenue and the credit given in proportion to direct cost will be unchanged. So we have to answer the question, what is credit taking in proportion to revenue? What is credit giving in proportion to direct cost? Please note, credit taking in proportion to revenue. That credit taking means receivables, trade receivables in proportion to revenue. Your credit giving in proportion to direct cost. That is your trade payables in proportion to direct cost will be unchanged. The increase in the business will require increased inventory of 5 million. So inventory value will increase by 5 million. Next paragraph. Depreciation on non-current assets existing as at 30th December 2017 is forecast to be 5.7 million per annum. That means annual depreciation on existing non-current assets is 5.7 million. And it is forecast that 10 million naira of new non-current assets will be needed. So we need to acquire a new non-current asset for 10 million naira. This, together with the new inventory, will be acquired in the year 2018, 30th December. Depreciation on this new asset will be acquired in the year 2018, 30th December. Depreciation on this new asset will be 18% on reducing balance basis, starting in the year of purchase. The company pays tax at 21% per annum in the year in which the liability arises. If you have to interpret that to yourself, that means tax is paid on actual year basis. The tax for year one will be paid in year one. And capital allowance are available at the same rate of depreciation. This implies that your capital allowance is equal to your accounting depreciation. Next, annual dividends are payable the year after the year in which the profits are earned or earned. That means dividend is payable. Dividend is paid 1 year after the profit is earned. It means that dividend for year one will be paid in year two. Dividend for year 2 will be paid in year 3. Dividend is payable in arrears, not actual year basis. The company intends to maintain the existing payout ratio. So the company plan is to maintain existing dividend payout ratio. Summary financial statements. We have the income statement for 2017 given to us. Revenue, direct cost, depreciation, indirect cost, interest payable, profit before tax, tax paid 21%, profit after tax, dividends. Next, we have the statement of financial position, non-current assets, current asset, inventory, what have you. You have the statement given to us. Dividend is reflected in your current under your current liability. Notes: the statement of financial position includes dividend payables as a current liability because dividend for the year have not yet been paid. For the purpose of forecasting, dividend that will be paid must be included in the forecast, and so is included in this statement of financial position for convenience. The proposed financing method are: 1, a 1-for-5 rights issue at 5 naira per share, and option 2, a 15 million naira term loan at 8% interest. Requirements A. For the 2 financing alternatives being considered by the directors of Food for Thought PSC, look at the question. For the 2 alternative financing, alternatives being considered by the directors of Food for Thought PSC, prepare a forecast, income statement for the year to 30th December 2018. Statement of financial position as at 30th December 2018. Then write a report to the directors that evaluate the proposed method of financing the expansion, or the proposed method of financing. We are done with the question reading. Assuming you are faced with this type of question, what is the best approach you can take? Because this question, look at the requirement, let's explain it. You need to prepare income statement for the 2 financing alternatives. That means you have alternative 1, right issue financing. You are going to prepare income statement for 2018 if the expansion is financed by right issue. When you are done, you also prepare income statement for 2018 if the expansion is financed by debt, new debt finance. When you are done, you now move to A2. You are going to prepare statement of financial position as at 2018. If the expansion is financed by right issue, then when you are done with that, you also prepare statement of financial position for 2018. If the expansion is financed by a new debt, that means you need to prepare 4 statements. And you are likely to prepare cash flow statements. Because part of the current liability, part of the current asset is our cash balance. This cash balance will come from your cash flow statement. If you don't know how to approach this question, if you are not smart with this question, you can be on this question for 2 hours. And let me also be practical with you. At times, the examiner will place this as the compulsory question. If you check 2017, this was examiner tested financial statement prediction as the compulsory question. 30 marks. If you check 2015 also, examiner tested financial statement prediction as the 30 marks. Please note, if the examiner is texting financial statement prediction, what is being texted is your knowledge of accounting principles. There is no formula, nothing to cram. The only thing is that it will take the extent to which you understand accounting principles. All right, let us go to this solution. I always advise students, for this kind of question, try to approach the question paragraph by paragraph. So let's pick our pen. I don't know if this 1 hour, 45 minutes will be enough, but we are going to try. Suggested solution. Forecast income statement. (2018), 2017. 2017 is given to us. For 2018, we want to forecast income statement if financed by right issue. Right issue. Also, we want to forecast if it is financed by new debt. Our Naira sign, 30 up, 30 up, 30 up. Open all the statements that you require. That page 1. This page will be for forecasting the income statements. This person has touched my screen. Each time you touch the screen, you are going to draw mark on the screen. 2, forecast statements of financial position 2018, 2017. This is given. Here we are going to talk of rights issue. Rights issue. Here we talk of new debt. Our Naira sign. Page 1 is for the income statement. Page 2 is for the statement of financial position. Our page 3 is for our workings. We now go back to the question. We are now going to start paragraph by paragraph to address this question. Back to the question. Paragraph 1, there's no calculation involved. Look at paragraph 2. A plan to launch new food options by the directors is expected to increase revenue by 10% per annum for the foreseeable future. That means in 2018, revenue will increase by 10%. Now go and check the income statement. What was the revenue for 2017? Look at it, please. 2017 revenue, 81,000 naira. Examiner said this will increase by 10%. Please come here. Revenue. Revenue is an item of the income statement. In 2017, revenue was 81,000. Please increase this by 10% to get 2018. Hello guys, we have started.
89,100.
89,100. Whether we finance the expansion by right issue or we finance the expansion by debt, revenue will increase by 10%. So the revenue will be 89,100. That has been treated. Back to the question. Back to the question. Continue. In order to finance the expansion, the directors are considering either a rights issue or a new debt finance. Okay? The overhead of the business should not be affected. Should be unaffected by the expansion in sales. All right, let's treat this. Examiner says the overhead cost of the business should be unaffected by the expansion in sales. So, what is overhead cost? What constitutes overhead cost to the business?
That should be the indirect cost.
Thank you. Indirect cost. The overhead costs are the indirect costs that cannot be traced to a particular product or a particular service. So let's go check. Examiner says indirect cost should be unaffected. Let's go check our statement. Look at this, please. In 2017, indirect cost is 12,000 naira. Examiner says this cost will remain unaffected. That means in 2018, the indirect cost will still remain 12,000. Let's go treat this in our account. Indirect cost is an item of income statement. You can come here. Let me create a space. I'm trying to follow what the examiner has said. Indirect cost. In 2017, it was 12,000. This cost will remain unaffected. That means in 2018, we are still going to maintain 12,000. 12,000. Whether we finance the expansion by rights issue or we finance the expansion by a new debt finance, the overhead cost of the business remain unaffected. If that is clear, we move to the question again. Other relevant information is as follows. The level of competitive rivalry between the suppliers to this industry is very pronounced. As a result, an increase in direct cost of 8% per annum is expected. That means direct cost will increase by 8%. So let us look at the income statement. What is the direct cost for 2017? For 2017, direct cost was 45,600. This will increase by 8%. You come here. Direct costs. This is 45,600 in 2017. Please increase by 8%. What do we have in 2018? Hello, guys.
49,248.
49,248. Direct cost will increase by 8%. Whether we finance the project with rights issue or we finance with debt, direct cost will increase by 8%. You observe that we are preparing the statement simultaneously. You have to take a smart approach in exam. All right. We continue from where we stop. This is where we stop. All right, the next. The working capital will be controlled in the same fashion as before, with no changes anticipated in the terms of trade. Thus, the amount of credit taken in proportion to revenue. Please note, credit taken in proportion to revenue means receivables in proportion to revenue, and credit given in proportion to direct costs. That means trade payables in proportion to direct costs will remain unchanged. Let us go and treat this. We need to know the proportion of credit taking to revenue that will remain unchanged. That ratio that will remain unchanged, we need to know the ratio. That will take us to working one. Let us look at it before we go. For 2017, receivables is 14,700, while payables is 12,900. Okay, that's fine. Let us go to our working now. This be okay, yeah, this should be the working. The third page is for our working notes. We start with working one. Receivables as a proportion of revenue. Let's look at it. Our receivables divided by, oh no, that is not good enough. Receivables divided by your revenue. Examiner says this ratio will remain unchanged. So we are going to compute for 2017. 2017. Receivables for 2017, 14,700. Revenue for 2017, 81,000. Please compute this ratio. You should have 0.1815. Please allow the class to be participatory. That will give me some level of comfort that students are actually following. This is the ratio of receivables to revenue. Examiner said this ratio will remain unchanged. We can use this ratio to forecast 2018. Look at it, please. In 2018, receivables divided by revenue must give me 0.1815. I don't know the receivable for 2018, but I know revenue. Look at it, please. Receivables divided by revenue. Revenue for 2018, we have forecast that 89,100 is equal to 0.1815. You can derive receivables for 2018. Is that not, please? Receivables is equal to cross multiply 89,100 multiplied by 0.1815. Please, what is receivable for 2018?
16,172.
Thank you. God bless you. 16,172. That means you have been able to predict receivable figures for 2018. Next, let us treat payables. Working two. Working two. Examiner says payables as a proportion of direct costs. Look at it. The formula becomes payables divided by direct costs. This ratio will remain unchanged. So compute for 2017. For 2017, payable figures, 12,000 year 2017 year, 12,900. Why direct cost for 2017? 45,600. Please determine the ratio. This will give you 0.2829. Examiner said this ratio will remain unchanged. You can now move to 2018. 2018. Payables over direct cost. We don't know the payables for 2018, but we know the direct cost. For 2018, 49,248. We have been able to predict the direct cost. This must give us a ratio of 0.2829. You can now derive payables for 2018. Payables for 2018 is equal to 49,248 multiplied by 0.2829. What do we have, please?
13932.
You can now post, of course, receivables and payables. These are items of the balance sheet statement. That is the statement of financial position. You can now go and do your posting. You come here. Look at it. I'm now going to forecast statement of financial position. Normally, we are going to start with non-current assets. We don't know that yet. Then we have the current assets. The current assets. Under it, you have inventory. We don't know this yet. Then we have receivables. For 2017, receivable figure was 14,700. For 2018, 16,172. Whether we finance by right issue or we finance by new debt, our receivable figure is 16,172. You have done the posting. Examiner can see that this person is posting the item. Even if you cannot finish all the questions, at least you are doing your posting. Next, payables. You can create space here. Payables is part of our current liability. We can create space and do our posting. Cash, having. Then I'm going to have assets, capital reserves. I can come here, create some space. Let me use here current liabilities. Under it, we have payables. For 2017, the payable figure, 12,900. For 2018, 13,932, 13,932. The payable figures will remain the same, whether we finance by debt or we finance by right issue, equity finance. All right, we go back to the question. We go back to where we stopped. This is where we stopped, okay? The increase in the business will require increased inventory of 5 million. That means our inventory will increase by 5 million. Let's go check. What is the inventory value? In 2017, inventory value.
10,500.
Thank you. 10,500. This value will increase by 5 million. That takes us to the balance sheet statement. 10,500 in 2017. This will increase by 5,000. That becomes 15,500. 15,500. Whether we finance by debt or by equity, the inventory value will increase by 5 million. We continue. So please, in exam, if you have question of this nature, just take it paragraph by paragraph. The next paragraph, depreciation on non-current assets existing at 30th December 2017 is forecast to be 5.7 million per annum, and it is forecast that 10 million naira of new non-current assets will be needed. This, together with the inventory, will be acquired in 2018. Depreciation on the new assets will be acquired in 2018. That depreciation is 18% on reducing balance basis, starting in the year of purchase. Let us go and treat this. That will take us to working 3. That will take us to working number 3. Working 3. Accounting depreciation. For 2017 and 2018. Annual depreciation, this is annual. Annual depreciation on existing non-current assets. On existing non-current assets is 5,700. On existing non-current assets. This asset is still existing to 2018. That means depreciation on existing non-current asset is 5,700. Oh, this one is too much. In 2018, we are going to acquire new non-current assets. That means depreciation on new assets. The value of that will affect only 2018. That new asset is acquired in 2018, so it will not affect 2017. The new non-current asset is 10 million. Depreciation is 18%, starting from the year of purchase. The asset will be acquired in 2018. So we are going to charge 18% of 10,000. That will give us 1,800. That means depreciation for 2017, 5,700. For 2018, both depreciation on existing assets and depreciation on new assets. That will give you 7,500. You can now go and post. Before then, we can also do, working for. Depreciation will affect both your income statements and your balance sheet statement. Depreciation will affect the income statement. It will also affect the balance sheet statement because you are going to compute the net book value of the non-current assets. So you can ask smartly here, working for non-current assets. For 2018, you have your Naira sign. You are going to start with opening balance of the non-current asset, opening balance. The opening balance for 2018 is the closing balance for 2017. Please check 2017 statement of financial position. What is the balance of the non-current assets? Hello?
$70,200.
Now, as at close of 2017, our non-current asset balance was 7,200. It was closing for 2017. It becomes opening for 2018. When you are done, acquisition for the year, acquisition of non-current assets, The company will acquire 10 million non-current assets in 2018. The total, that becomes 8,200. Less depreciation for 2018. Less depreciation. 7,500. That will give you net book value as at 30th December 2018. Please compute. What do you have here? 72,700. They just try to be helping me to get figure. So you have to encourage me. You know, lecturer too can also sleep. It's very possible for a lecturer to sleep off.
You're active, so.
No, but it has happened before. The lecturer was tired and he just slept off. Students were calling. The guy was tired now. So you can return here now. Non-current assets for 2017, 7,200. For 2018, 72,700. 72,700. Then go to your income statement. Our depreciation. In 2017, 5,700. In 2018, 7,500. 7,500. With this, you can get your profit before interest and tax. With this, you can get your profits before interest and tax. Revenue, less direct cost, less depreciation, less indirect cost. This will give you your profits before interest and tax. Let's compute. This should be 17,700. This is 20,352. 20,352. You can reconfirm, please.
Confirmed.
You can reconfirm. Okay, fine. Next, logically, you can now say, let me compute interest. Since I have gotten profits before interest and tax, then I can quickly compute the interest. We come here, interest cost. Check 2017 figure. What was the interest cost?
$1,500.
1,500. Now in 2018, I want to ask the class. If we finance the expansion by right issue, will your interest cost increase?
No.
No. The question again. The answer is no. If we finance the expansion by right issue is an equity financing. That means our interest cost will not change. 2 is here. 1,500. That is the interest on existing debt.
Or it will be lower.
If you finance in 28, assuming you finance the expansion by debt, what happened to your interest cost?
It will
Goes up.
increase.
It will increase. Now let's go and do that working now. That will take us to working for. Or working 5. Interest cost 2018. You start with existing interest, 1,500. Then new interest. The new debt is 15 million. Let's show ourselves. Look at it. Look at it, please. The proposed financing method are 1, look at 2. 15 million term loan at 8% interest. That means the new interest is 8% of 15 million. The new loan is 15 million. The interest is 8%. Please compute 8% of 15 million.
1,200.
Thank you. The new interest is equal to 15,000 multiplied by 8%. That will give us 1,200. That means total interest 2,700. If the expansion is financed by debt, then the interest cost will be 2,000. Just come here. 2,700. That will be the interest cost. You can now get your profit before tax. Profit before tax. Let's compute. This should give us 16,200, 18,852. What do we have here? I'm not sure of this.
17,652.
17,652. What next? Tax. Let us go back to the question. What is the tax position? Look at where we stop. The company paid tax at 21% per annum in the year in which the liability arises, and capital allowances are available at the rate of depreciation. So you can compute tax now. Taxation is 21%. Please compute 21% of 16,200. What do we have?
3,402.
402. Also compute 21% of 18,852.
3,959.
3,959. Also compute 21% of 17,652.
3,707.
3,707. You can derive your profit after tax. Profit after tax. What do we have here? 12.
For 2018, the last column. 13,945.
945. Oh yeah, oh yeah, oh yeah, oh
Okay,
yeah.
2018, 14893.
893. Next. 12 son. This should be 12 son. I'm not sure of this. 12,000. 7 was
98.
Thank you. After your tax, what remains? Let's go and look at dividends. Dividend is the amount of profit after tax that is distributed to shareholders in the form of cash. So let's go and look at the policy on dividend for this company. Back to the question. Okay. Look at the dividends here. Annual dividends are payable for the year. Are payable the year after the year in which the profits are earned. The company intends to maintain the existing payout ratio. That means we need to determine the existing dividend payout ratio. We are going to use 2017 figures to determine the existing dividend payout ratio. Because this ratio will be maintained in 2018. So let us go and compute. Please check the question. What is dividend payable in 2017?
$7,679.
7,679. We can now calculate dividend payout ratio. That will take us to working, I think working 6. Yes, working 6. Working 6. Existing dividends pay out ratio. The formula is for 2017. The formula is dividends divided by profits after tax multiplied by 100. Our dividend for 2017, 7,679 divided by the profit after tax for 2017, 12,798 multiplied by 100. Please work out the payout. Please work out the payout ratio.
6%.
60%.
6%.
Please recompose. It can't be 6.
Sorry.
Percent.
That looks like 50%.
60.
60%, sorry.
It is
60%.
Thank you.
60%. Yeah,
The
60%.
ratio is 60%. What that means is that 60% of the profit after tax is paid as dividend. This ratio will be maintained in 2018 because the company plans to maintain existing dividend payout. You cannot go to 2018. 2018 under rights issue. Rights issue. We now compute the dividend payable. The dividend payable is equal to 60% of profit after tax multiplied by 14 what? 14 what, sir? Let me quickly check.
893.
14,893. Thank you. Please compute 60% of 14,893.
8903. $8,903.
The answer is what?
8,903.
8936.
893. Is it 03?
I got 8936.
That's the correct answer. 8936, not 003. When you are done, also for 2018, for debt finance,
837.
we have 60% of how much? 13. That will give us how much?
836.
83.
67.
Oh, 667. Thank you. You can now go and post. That is the dividend payable. 8936, 8367. Come here. Oh, you are running too much. This is 8936. Dividend payable. Dividend payable. This is 8367. Because it's dividend payable, we have not paid dividends. Because it's dividend payable, dividend for 2017 is to be paid in 2018. Dividend for 2018 we paid in 2019. That means that dividend will reflect as part of your current liability. You can come here. As part of the current liability, our dividend payable this is 7679. This is 8936. This is 8367. It's part of current liability. Because the dividend has not been paid, this must be reflected in your balance sheet. You can now get your retained profits. Profit after tax, less dividend payable, we give you retained profits. Please compute.
Two 2017, 5119.
5119.
119.
Please compute.
218, right issue.
Please go ahead.
For the new debt, 5578.
5578.
78.
I think the guy's line went off.
Five 957.
5957.
57.
We are done with the income statement forecasting. We have done the forecast for 2018 under right issue and for 2018 under new debt finance. Let us go and complete our statement of financial position. In the exam, you can follow the examiner, what the examiner has given you, the statement you are giving. Look at
We don't
this.
have time. We don't have time because I would have asked the question maybe when you are done.
Okay, you can always ask.
Okay, so when we're trying to recognize the interest expense in this calculation,
Yeah.
if we opt for the right issue, maybe they didn't give us enough parameters to make this guess, because the owner of the business would have taken the proceeds from the right issue to probably reduce their borrowing. So that was not factored in. Is it because maybe we didn't get enough information to incorporate that in what we are doing and just assume that the proceeds of the right was used for something else?
The question did not specify that the proceed of the right issue is used to repay the debt. Is that clear,
Okay.
please? So
Yeah.
you cannot bring in a view which is not in the question. That proceed is used for expansion. It is not used to repay the existing debt.
Yeah.
Aha.
Yeah. Fair enough. Yeah.
So I'm trying to say that you can look at the format you are giving to follow it. Look at it. I want to go to the statement of financial position now. Look at it. Non-current asset net book value, the current assets, inventory, receivable, cash, total assets, capital and reserves. You can follow this format too. So I'm going to follow the format given by the examiner here. I'll go to my statements. I will come here. Okay, this is it. I'll come here. I'll pick my cash at bank, 3,150. I don't know the figure here yet. I'll leave that open. Then please get the total assets, summation, total assets. Please add 7,200 plus 10,500 plus 14,700. This will give you 89,550. You can close this. Please, you can't close this yet. We don't know the figure yet. Then next, come to your capital and reserves. Under it, you have the share capital. Share capital. ₦1 nominal value. For 2017, the total amount is 15,000. Okay. Now, right issue. If you do right issue, that is, you are issuing new shares to existing shareholder. Will this affect your share capital or not?
It affects.
It will affect your share capital.
Yes.
That will take us to working number 7. That will take us to working 7. We want to look at the impact of right issue on the share capital. So come here. Working 7. Right issue. The right issue is 1 for 5, right issue, 1 for 5 at 5 naira per share. So we want to do a right issue, 1 for 5. That means for every 5 existing shares, we are going to issue 1 new share at a right. For every 5 existing shares, we are going to issue 1 new share at a right. So the question is, how many new shares will this company issue under right issue?
3,000.
How many?
3,000.
Thank you. Number of new shares. Let's show the working. That becomes 1 over 5 multiplied by existing shares, 15,000. That means 3,000 new shares will be issued at 5 naira per share. The next order we are going to cross now is the nominal value per share is 1 naira. Why this new share is issued at 5 naira? That means the new shares are issued at a premium. Nominal value per share 1 naira. Now we want to issue new shares at 5 naira per share. That means by implication, the unseen now is that these new shares are issued at a premium. And I want to ask the class, under your financial accounting or your corporate reporting, if you issue shares at a premium, how do we treat this in our book of accounts? When you issue shares at a premium, how are you going to treat this in your book of accounts?
You credit the share premium account to the difference now.
Thank you. Then we are going to separate the nominal value of the share from the premium aspect of the share. Nominal value will be credited to the share capital accounts.
Yeah.
While the premium aspect will be credited to the share premium account. The same thing will be treated. You come here and do like this. Nominal value of new shares. This is equal to 3,000 multiplied by 1 naira. That gives me 3,000 naira. Share premium out of 5 naira, 1 naira is the nominal value. That means 4 naira is the premium. The premium is equal to 3,000 multiplied by 4 naira. That is 12,000. This 3,000 naira will be added to the share capital account. Why this 12,000 naira will be taken to share premium account. You can come here, come and do our posting. You come here. Before, the share capital is 15,000. This will increase by 3,000 naira. This become 18,000. We are coming back to the share premium account. Now, let me ask. If you, assuming we finance the expansion by debt, will our share capital account change?
No.
No, sir.
That means share capital will remain 15,000. You now come to your reserves. Please, just 1 minute. Just 1 minute, please. Let's continue. Reserves is, this is equity reserves. It contains all reserves related to shareholders. Now check 2017. What is the equity? What is the reserve figure? Please let me check 2017.
47,971.
47,971.
47, sir.
Oh, 47. Okay, thank you.
971.
I need to pick the eraser. Okay, 971 is an error. Nine, 7, 1. Okay. We now need to determine reserve for 2018 under rights issue and reserve for 2018 under debt finance. Let's go to it. You're almost done, don't worry, you're almost done. That will take me to working, I think working 8 or thereabouts. It's about working, I need to move. Yeah, working 8. We come here, working 8. Rights issue. Rights issue. Or debt finance. I want to calculate reserve. You are going to start with your opening balance. Opening balance. Whether rights issue or debt finance. Opening balance for 2018. The opening balance for 2018 is the closing balance for 2017. That will be 47,971. 47,971. That is the opening balance of the reserves. We now come here. Share premium. Under rights issue, there's a share premium of 12,000. Your share premium is part of your equity reserve. And that money belongs to equity shareholders. But if the project, if the expansion is financed by debt, there is no share premium. Next, Go and pick your retained profits. Your retained profit is part of your reserves. Check for 2018 under right issue. What is the retained profit?
5957.
5957. Under debt finance, what is the retained profit?
5578.
5578. You can now get reserves. For right issue, please compute what is the reserve. For debt, what is the reserves? This is reserves. Please add up.
65,928.
65,
928.
65,928. And what do we have here? 53,
53549.
549. You can go and do your posting. 65,928, 53,549. Go to the statements. Statement of balance sheet now. Oh, just jumping. This is 65,928, 53,549. You can sum these two together. Share capital plus reserve will give you shareholders' funds. Shareholders' funds. Please sum together. This is 62,971, 83,928,
68549.
549. Then you can pick your non-current assets. Non-current liabilities. We have existing debentures, 15% debentures. The value is 15,000 naira in 2017. These debentures have been existing in 2017. In 2018, the existing debt is still there. Let's explain that. Before 2018, the company has existing debentures of 15 million. In 2018, if the project is financed by right issue, the existing debt is still present. That means we still have the existing debt here. This is still existing here. Oh. $15,000. This debt is still existing in 2018. In 2018, we have, oh, this is 10%, not 15%. We have 8% term loan. This will not affect 2017 because this term loan happened in 2018. If it is right issue, If the expansion is financed by rights issue, then the term loan will not affect 2018 year. But if the expansion is financed by debt, the term loan will affect us here. That is new debt finance, term loan. You can have sum up. Shareholders' funds plus non-current liability plus current liability. Please sum up this figure. That is capital and liabilities. Please sum up. This should give you 89,550. It will balance. Look at the total assets. Oh, why are you going too far? The total assets here for 2017, 89,550. Total asset equal to capital plus liability. Accounting equation. This we learn in our 4th year of accounting. Your total asset must equal to the capital and liabilities. So please sum up. Shareholder fund plus non-current assets, so plus non-current liabilities plus current liability. What is the total, please? We need to round up this question. It's 11 p.m. Please sum up.
One to one. 1 to 1. Right issue.
1 to
796.
796. That means the total assets here should be, we are going too far. The total assets here, this should be 121,796.
I didn't get 121, sir.
You cannot get, what do you say?
For the total assets, I got 104,372.
For which year? Which?
2018 right issue.
Please reconfirm your computation. It should be 121,796.
Can you please scroll up? Let me see the non-current assets. I think I have the same figure.
Look at it here. Shareholders fund, non-current assets 15,000.
Yeah.
Non-current liabilities 15,000. Current liabilities, sum these two together. Here's the final one. What do you have here? 120. Eight, 4, 8. Please reconfirm this.
120,848.
Correct. That means capital and liability is equal to total asset. This should be 120,848. You can now get your balancing figure to round up. You can come here. Your balancing figure is your cash. Look at this figure here. Figure here is missing. That means you are going to add 72,700 plus 15,500 plus 16,172 minus 121,796. What is the balancing figure, please? That is your cash at bank. What is the balancing figure, please?
17,424.
Yes, balancing figure.
424.
Sorry, I stepped out of here. Sorry, 17 was.
424.
So we have 17, 424. Now come here. What is the balancing figure here? The balancing figure here?
16,476.
16,
476.
476. You can submit this to the examiner. But 15,476. This should be 4. You can submit this to your examiner. Alternatively, you can prepare your cash flow statement to be able to get your cash balance. Because we are not asked to prepare cash flow, examiner may not penalize you. Just use the balancing figure to get your cash balance. But if you are required to determine the cash flow statement, then you can use balancing figure now. Assuming you are required to prepare cash flow statement, then we cannot use balancing figure to get our cash balance. All right. The time is well spent. We are done with the question. The B part is to do a report. A report evaluating the 2 proposed financing options. And we have done this report severally. What are the financing options? Right issue and debt finance. So you are going to explain to us what is right issue. What is the impact of financing right issue on the company's profits, on the company's risk? When you are done, you now explain debt finance. What is debt financing? What is the impact of financing an expansion with debt on our earnings and on the company's risk? To God be the glory. All right.
Did you ask a question? I didn't know you asked a question.
No, he said that today is the first day I started and end the class.
Okay.
You know, for some, the network, for some, they're actually sleeping. They are not, they just log on to the class, they just go and sleep. All right. So I'm going to include the reports as part of the working notes. What we expect is, please go through the reports so that you can familiarize yourself with how to produce that report in the exam. All right, let's have a blessed evening. May God give us a better understanding. Good night.
Amen. Thank you, sir.